There's a phrase that we've heard a million times on this program. It's different this time. The yield curve, the bull steepener, typically associated with an economic downturn, it's different this time. The move we've seen off the low on unemployment over the last 12 months, people are saying it's different this time. They're taking comfort from the supply side story. How misplaced do you think some of those conversations are, given what you've already told us this morning?
Yeah, John, no doubt. You hit all the important points. I think it's a risky story, and the storyline is simply that jobless claims are still low and job growth is still positive. So don't worry so much about these other forces and factors. In particular, this move up in the unemployment rate, 0.8 of a percentage point from the cyclical lows. That's something that's unprecedented outside of the economy moving into contraction. Now, it's always possible that it's different this time, but if the view is soft landing story intact, that backdrop has to make one increasingly nervous, or at least should make one nervous. On the productivity story, I think a lot of this relates to the upheaval associated with the pandemic. We had 8 quarters where productivity was negative between late 2020 and late 2022. At that time, nominal demand was booming by double digits. So if you have really strong demand and contracting supply, what happens to prices? They go straight up. As those distortions have unwound, we've actually got a nice pickup in productivity growth. So it's not totally fantasy land, but it's probably temporary. And I think what's happening here is some people are extrapolating this recent temporary recovery in productivity out way into the future based on a lot of AI hype. And if that proves to be a bit disappointing, then I think risk markets are going to stay choppy here.
I want to dig a little bit further into something that you mentioned earlier, saying that history shows that analysts' 12-month earnings forecasts tend to be about 30% too high at cycle peaks. You said that most bear markets are usually about a 30% drawdown. Putting aside recession or not, are you saying just based on profit estimates that you see a 30% downside risk in headline S&P indexes?
Yeah, I think there is significant downside risk here, recession or no recession. The S&P 500 is right around 21 times extremely optimistic forward earnings estimates. Even if those estimates end up not incredibly inaccurate, that kind of a multiple historically would be associated with exceptionally low 10-year forward returns, close to zero, even negative. And so from these levels, even in a good story for the business cycle, I think we have to expect much lower future returns. And unfortunately, what seems to be happening is investors are looking at the last 2 years of a straight up and to the right S&P 500 and just assuming that's going to go on forever. There's some pretty startling anecdotal information out there. You guys may have seen the recent Wall Street Journal story that was talking about how individual investors are super optimistic on stocks. They quoted a gentleman in his late 60s saying the conservative approach to markets is all in all the time. I mean, this is the stuff of market tops, not ongoing bull markets that are still intact. So it makes me a little bit nervous.